Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at volatility means opportunity in Mosaic, MOS, a fertilizer company that saw some huge, unusual call activity yesterday that certainly moved the implied volatility surface, setting up for a vol capture trade with some edge. So let's jump in and take a look. First of all, here's one of the scanners. You can see Mosaic with almost 50,000 options trading versus a little bit more than 12,000 the normal volume, so more than four times the average volume. Just as importantly, IV now basically at the highest level we have seen in the past year. Another scanner which does it on a individual basis, right? The June 40 calls saw the biggest volume again showing up here, where IV has increased at least three vol points, right? So the June 40 calls with almost 12,000 contracts trading on those. How did that affect IV? We can see that implied volatility, right, pulled off the 90-day IV on this example, right? Now at by far the highest level since going back to these are the Liberation Day lows where the market was getting absolutely hammered. The VIX was at the highest level of the year, but you can see implied volatility shooting up because of this unusual option activity from yesterday to today. You can see IV just lifted dramatically, to say the least. Also, IV now trading at by far the highest level we've seen over the past 20 days. Interesting to note, too, that calls far outpacing puts with the IV, right, because of all that buying being predominantly, as we can see, focused in the call side, right, as rushing in to just buy calls to position for further upside, perhaps in Mosaic. You can see those June options with over 18,000 contracts traded over a 6 vol point lift. And there took a look at a little bit longer term chart. Here's a 2 year IV chart. You can see IV back at the highest level we've seen over the past 2 years in Mosaic, right? You can see previous instances where we saw these vol spikes were met almost immediately with a reversion back. We expect that again. On a shorter term basis, you can see over the past 6 months, IV now at by far the highest level, right? And previous spikes almost inevitably met with quick reversions. Most of these, in fact, these two were earnings based. This one not earnings based. It's simply on the fact that shipping is becoming maybe problematic. Taking a look at those big June 40 calls where that volume came up, did a compare to there going back to February 9th, where the stock closed at 29.56, right? There was 129 days to go to expiration. Those June 40 calls were trading 57 cents to 67 cents and just over a 45 IV. Again, the stock at 29.56. Fast forward to yesterday's close, right? You can see the stock closed at 29.15, right? Up sharply off the lows, right? But those calls actually trading at a higher level, even with the stock lower back then, our kind of benchmark 29.56, now 29.15. So the stock dropped 41 cents, right? Time had passed from 129 days, right, to basically under 100. So pretty much a month has passed, right, which normally would lower the price of options, right? Lower stock price would normally lower the price of a call option, right? But because of that huge buying, right, over 12,000 of these trading, lifting the IV to now 52 and change versus 45, you actually saw the calls up in price even with the stock lower, right, from a month ago. So both of those should lead to much lower call prices, but instead, because of that big call buyer, call prices actually went up in price. So that set up ideally for a June strangle, selling the calls and selling the puts to hedge, right? Leaning bullishly with that call buying out there, right? But capturing vol on both sides. So took a look at a June strangle, right? Going back now to February 18th, the stock closed at 29.08. The June strangle selling the $30 put and $40 calls. So the puts slightly in the money, right? The 30 strike with the stock at 29.08. The puts are in the money by a little bit less than a buck and carrying just under a 50 delta. The calls well out of the money with a 15 delta. So if you sold the puts, sold the calls, right, you would be 34 deltas net long. So certainly a bullish position. You would receive $4.13 back on February 18th. Fast forward to yesterday's close, right after that huge call buying, right, we can see that that same sell strangle, right, has actually increased in price by 24 cents, going from 413 to 437, right, even with the stock moving up slightly, right, from 29.08 to 29.15. So creeping a little bit closer. Ideally, you want it above 30, below 40. So the stock went up in price virtually the same, right? But because of that big call buying lifting IV, we actually see that sell strangle, right, going up in price by 24 cents, even with the stock higher. And even as we said, with time passing right back then, we had, 120-ish days, right? Now we're looking at about 100 days, a touch less than that. So you saw time pass, which should cheapen option prices from time decay, right? We also saw the stock moving closer, going up on a bullish trade. You'd expect it to be profitable, but instead you're able to get 24 cents more by selling that strangle, and you're still leaning definitely bullishly with that big call buying out there, right? Where you're selling a 42 delta negative, selling a 19, so you'd still be leaning right very bullishly by 23 deltas on this. So certainly a way to go about capturing IV, lean bullishly with that call buying out there, and hopefully get the best of both worlds. But taking advantage, more importantly, of that huge IV spike and looking for that reversion back like we have seen almost inevitably in the past. So until next time, as always, here's the good trading.